Thanks for joining us to find out more about risk, fees, and taxes. I know you're concerned about the tax laws and what's happening. The new tax laws just passed recently.
Yes, and so we will get to all the new tax laws that were passed in Congress and Senate, and then Congress again, and the president signed all these new tax laws. I think something like 900 pages.
Wow.
So
But
we'll
first,
talk all that.
I'm Imran Razvi. I go by Raz. This is Daniel Razvi. He's my oldest son. He's a tax attorney. And we're going to talk to you about the three biggest killers in retirement: risk, fees, and, yes, of course, taxes.
Yes. So when we talked about risk, do you always have to take risk to get a good reward? No risk, no reward, right?
Now, we'll show you that you don't necessarily have to take a risk in order to still get some reward. It just depends on what you're trying to do. So as a fiduciary, we have to find out what is important to you and find the right investments.
Okay. And then for fees, I mean, I've heard most people pay 1% to their advisor. Is that a normal thing to do?
They think they're paying 1%, but a lot of times, a lot of hidden fees in there. We'll uncover some of those. And when we do a risk, fee, and tax analysis, we usually find that people are paying close to 2 to 3% in fees, which is a lot. And it doesn't really seem like a lot until you put a dollar figure on it. So we'll show you how much that really means.
Okay.
But, you as a tax attorney, how much do we actually save people in taxes?
Most of our clients, we save over $1 million in taxes. So just to be clear, working with Higher Ground is very common to be able to save over $1 million in taxes in retirement, and also to be able to retire several years earlier than you thought was possible, with up to 50% or more additional income in retirement.
And that's a really cool thing because a lot of advisors really don't go over the income plan and tax plan, how to minimize the taxes when you retire, and how to make sure that you don't outlive your income. We do all of that. So let's get going.
All right. So first of all, we have this thing about taxes.
Ben, where's all your money gone, Daddy?
Taxes. 9, 10, 11. Let me fix my houses.
Bug, it's okay. It's part of the game.
No, it's not.
It
It's not fun.
It's not fun to what?
It's the worst part of the game.
Is what?
Taxes.
And that's why you're here, right?
The worst part of the game.
The worst part of the game.
All right. So who are we?
So I'm there on your screen with all the kids around me. I have no beard on this one. And my wife is right below me. I have 13 children. And before you start thinking, does this guy know how that happens? Yes, I do. We actually have 5 by birth and 8 by adoption. And we love every one of them. And then now we also have 7 grandchildren, which is wonderful.
And more every time coming up, but it's every few months seems like. This is me and my wife on the other side of the screen, and I only have 2 kids so far. They're 4 and 2. They're beautiful. I love my kids, and in fact, my 4-year-old daughter came up to me the other day and said, "Daddy, what is a Roth conversion?" And yes, she said, "What is a Roth conversion?" And I said, "How do you hear this?" And she said, "Well, you were talking on the phone, and I heard you say Roth conversion. So what is a Roth conversion?"
So kids hear everything you're talking about.
Yes. And I said, "Well, here's what a Roth conversion is. You have to pay taxes. Everybody's got to pay taxes. That means some of the money you earn, you have to give to the government so they can build the roads and the bridges and pay for the police officers and all of that. But nobody likes paying taxes." And she said, "Daddy, sometimes you have to do things you don't want to do. That's the law." And I said, "Yes, that's true, but you could choose when to do it, and you have a choice. You could pay them now, or you could pay more later. So imagine this. Imagine you were eating some food that you really don't like. And I said, you have to eat this one more bite of food that you don't like it at all. So you can do that, or I'll take the food away, and you don't have to eat it today. But tomorrow you have to eat 10 bites of this awful food. Which would you prefer?" And she said, "Daddy, I'd rather have the food now, the one bite now." I said, "That's a Roth conversion."
Yeah.
So now my 4-year-old daughter understands Roth conversions. We'll break it down for more for you later in this seminar. But first of all, when we're not talking about taxes, we have a ministry here.
It's conquerbylove.org. It's Conquer by Love Ministries, a nonprofit organization that really focuses on giving parents tools necessary to help children emotionally grow stable and healthy, and try to avoid medication and give the tools to parents to educate and encourage and strengthen the relationships with their children. We've written about 45 books. They're available on Amazon.com as well as Conquer by Love, and we speak all over the country to different groups of people to help them.
And we talk about our businesses, Higher Ground Financial Group, Higher Ground Legal. We have clients nationwide, so we are entirely virtual. We do not do any in-person meetings. It is all on video call.
And this is actually a benefit to you because you don't have to worry about driving in traffic, or taking gas, waiting in our office, sitting down, waiting for somebody else to leave. And this allows us to focus entirely on you, and you can actually talk to us from anywhere in the world. We have clients that have retired into Portugal or Costa Rica, and they still talk to us. It's a wonderful thing.
So if you want to meet with us, you can go ahead and click the link and schedule an appointment with us, and we'll talk to you about how you can reduce risk, fees, and taxes. But let's move on. So what do we do for our clients? Those are the three things. The main three things is if you get rid of risk, fees, and taxes, everything else gets better in retirement.
Because then your retirement income goes up, you increase your protection for your family, and you pass more to them. So instead of passing more to everybody else, you get to keep them for your family. And of course, we are fiduciaries, and what does that mean?
That means everything is required to be in your best interest when we discuss with you at all times, except for today on this webinar.
This is not general information.
Exactly.
So we can't really have it focused on you specifically. So we can't be a fiduciary unless we know more information about you, so we can actually give you advice based on what you want.
All right, and we'll put together a plan for our clients. We want to show you what a difference it makes with us versus without us.
Right now, out there on your own, your life expectancy is like here. With me, it's here. Without me, here. With me, without me. With me, without me. So, I wouldn't advise going home, but it's up to you.
So this is from Night and Day. It's a great little clip. It's a family-friendly movie, but it's not really your life expectancy. We're not trying to kill you off. This is your money's life expectancy, because we deal with money. So if we eliminate the risk, fees, and taxes, you get to keep more of your money. Your life expectancy for your money is much, much greater.
Anybody recognize this guy? This is only a small picture, but if you're a big Star Trek fan like me, then you'll recognize this is part of the face of Commander Data, the android from Star Trek. His name is Data, and I am a huge Star Trek fan, so I love this picture. But for most of you, if you're not a Star Trek fan, the first picture is really only insufficient data, and we want to give you complete information, sufficient data to make good choices about your money instead of poor choices. So what is a tax?
Well, the definition of a tax is a heavy or onerous demand on resources. And what that means is anything that's taking money away from you in your pocket, that's a tax.
So it's not just federal tax or state tax?
No, there's three types of tax we're going to talk about. Again, risk, fees, and taxes, right? There's market risk, which is when you lose money in the market, it's gone. It's a tax. It's not going to come back. You may grow from where you are. There's not just a paper loss. So all those people saying paper loss, no, they're lying to you. And then advisor tax, well, that's a fee. And when you're paying that, it's coming out of your account, and you're no longer getting any growth on that. So that is a fee. Now, it's a tax. Now, if you're not getting anything good out of that fee, then it's not worth paying it. So we got to identify what it is you're paying, and are you really getting something worthwhile? Because now you can actually invest and do a lot of things without having to pay that fee. And then, of course, there's federal and state taxes, and that's changed just recently. So that tax law was just passed, and we're going to talk about how does that affect you.
Exactly. So why do we have a can here?
So a can is to illustrate something. Every one of us has at least one or two cans in our pantry, right? Probably a lot more than that. But the story behind that is Napoleon wanted to conquer the world, but his food would spoil. So he put out a contest. Somebody please help me preserve my food. And this is the original can. It was invented in 1810, and this preserved food had a lid, is sealed tight, and the food stayed well very long, and he could use that on his campaigns. But there was something missing from this picture. So what they would give you, the instructions were, hey, take a hammer and chisel or take a rock and bang it open. That doesn't sound too good. So what was missing is a can opener. So the can opener didn't come for about 50 years later. And why are we talking about the can opener? The reason is you've been working for 50 years, putting your money away in your retirement accounts, IRAs, 401ks, TSPs, 403bs, all of those things, and now you got to get it out. Do you really want to use a rock to try to smash that thing? No, it's going to ruin some of that. So we are the can opener. We're going to help you save money on risk, fees, and taxes and be able to take the money out properly and not spoil it all. And that's very important. That's why we put the can up.
So what is our agenda for today? We're going to talk about those three killers, risk, fees, and taxes. And we're going to start with risk and fees, and then we'll go into taxes, talk about all the new tax laws. And then we do have a very limited time on this presentation, but if you have questions, you can either put in the comments or you can email us or make an appointment with us afterward to get some answers specifically to your situation. And first of all, let's talk about, we have been hitting all-time highs. And it's gone down, it's gone up, it's gone down, it's gone up. And as soon as I say these words, it's going to change again. But the market has been kind of flat so far in 2025, up through the first half of the year anyway. And what does that mean? we're at all-time highs, but that doesn't mean it's that much better than it was last year.
Yeah, it was a roller coaster ride this year. I mean, the first half of this year has been pretty flat, but it's been up and down, giving a lot of people heartaches and headaches and heart attacks.
So let's move back a little bit. So let's look at 2023 and 2024. We had 2 back-to-back years with 20% or more gains.
When was the last time that happened?
The last time was 1998. This is the best time since 1998 for the stock market.
So what happened after 1998? Well, we had the dot-com bubble. Right after those big, huge gains in the stock market, the market crashed big time. People weren't expecting it. Well, not everybody. Some people were expecting it.
So all those people that are concerned that the new administration has a lot to do with the fluctuations in the market. This was put out, the last 2 years before the new administration. Nobody was really expecting a huge gain or huge growth in the market afterward because it really rarely happens for 2 years, even less often for 3 years in a row. So what happened a year before that? In 2022, we had a 19% loss in the stock market.
It was actually 25% during the year, and then it came back just at the last minute.
Exactly. So what happened after that? We had a 24% gain. Then we had a 23% gain.
Woohoo, that's great.
But the total for all 3 years is still only 24% because you had to overcome. Because remember, when you go down...
Yeah, but still 24% is a lot of gains.
That's true, but if you divide over 3 years, it's really only 7% return annualized for 3 years.
And I thought 24% was much better than 12% that they say they were going to get.
Now, let's be clear. I mean, if you were going to be able to get 7.26 guaranteed for the rest of your life with no market risk...
Sign me up.
Most people would do that if they could. But that's still not nearly as good as saying, oh, I got 24%, I got 20. Yes, in a single year you could do that, but long term the averages are not as good. And this is the most important thing. This is for money that you're not spending. If you took even $1 out during this time, you took a lot longer to recover. Your annualized return is significantly less because withdrawals hurt you so much in retirement if the market's down.
Right.
Okay. Now, bonds have not been doing well for the last several years. They may start doing better if the interest rates go down. That's kind of counterintuitive, right?
Yeah, because usually when your market is very volatile and then you get closer to retirement, they tell you to move more money to bonds because it's safer. Well, it wasn't safe for all these people that moved money to bonds over the last several years because the interest rates were so low. When they went up, the bonds crashed. And many people lost a lot of them.
Why did the bond crash? Oh, it's because
the new bonds had a higher interest rate, so the bonds you owned were worth less and less, and so you just lost money on the bonds, and people weren't expecting that. Now we have pretty high interest rates. However, because the U.S. is going to need to refinance $3 trillion of debt, that may actually cause the bond rates to go up again. So that means your current bonds may actually lose value. We don't know. It's a very volatile time period, and so bonds are not as safe as they used to be.
Now we have this chart here on the screen. If you look carefully, I know it's small to read, but from 2000 to 2022, this looks like those gray spots and the dips kind of look like those market crashes we had.
Yeah.
But this is not actually the market crash. This is the federal funds target rate, the interest rates.
So is it mimicking it or what? So what happens is the Federal Reserve raises interest rates, and then right at 2000 we had that big crash. Right before that, they started dropping rates, so they saw that coming. They saw there's a problem, and so they wanted to have a soft landing. Well, it didn't have quite as soft a landing as they thought. And then once they hit the bottom, they started raising rates again. And then in 2007, they started dropping rates rapidly because the 2007-2008 crash was huge, and that remained low for a long period of time. And then they started raising rates again, and in 2020, they started dropping rates right before COVID because they knew something was happening. But then the U.S. government printed $3 trillion and dumped it in the market, so we had the fastest recovery. But when you have $3 trillion that are printed, you're going to have inflation. So because of that huge inflation, we had the highest interest rate hikes in history, and we went through that. And then right about around the election time, right before election, they started dropping rates a couple times. I think it was more of an election type of thing, because since then they have not dropped any. And the market is still having a problem. We still have inflation, which they say is now under control, but I'm not really sure about that. And, by the way, how bad has inflation been?
How bad?
Well, I've been getting pre-declined credit card offers in the mail. That's how bad it has been. So, anyways, they think that they might even raise rates again this year. So it depends on unemployment and inflation and what's happening in the marketplace.
And then, is there going to be a crash in 2025? Well, this is an article from last year where it talks about there's 7 different risk factors, only one of which is that famous T word now, the tariffs. But there's 7 different risk factors that really affect the market, and are especially housing right now is a really big one. The housing market is having some issues. Now, we'll talk in a little bit about a PMI deduction that is coming back that might help with the housing market. We'll see. But in any case, all of these are not going away anytime soon, so the market is in a dangerous spot. And keep that in mind. Even if we keep hitting all-time highs, what does everybody tell you? They say buy low and sell high, right? Well, if it's high, maybe it's a good time to shift to more safe, and not necessarily bonds, but things that are actually safe and protected. We'll talk about that in a second.
This is a perfect time. Carve off your winnings and let's stabilize that. So, is the next crash going to be worse than 2008? Well, Fitch Ratings predicts an impending commercial real estate crash that will be worse. What does that mean?
So not necessarily just the stock market, but commercial real estate. And commercial real estate is sitting empty right now. After COVID, a lot of companies moved virtual. We moved virtual. We're talking to you virtually, right? This is a changing world, and nobody is working from the office anymore, and a lot of these office buildings are sitting empty, right. But those loans are coming due and those leases are coming due to renew, and a lot of companies are dropping them. That is a crash that's already happening, right. And it's creating some big problems because of regional banks too.
Who owns the mortgages? The regional banks. When you get a loan for a building, you usually go to a regional bank that knows the economy in that area. And regional banks are very, very profitable. So they're held in mutual funds and hedge funds. They all hold them. The problem is if regional banks starts crashing, FDIC insurance only has enough money to really protect 4% of the regional banks. That's it. Everybody's, we got FDIC insurance, but it doesn't have enough money. So if it doesn't have enough money, that's going to be a problem, and that could really drag on the economy through the grinder.
And then we have a real unemployment rate, or effective functional unemployment rate.
24%. That's crazy.
Yeah.
I've been reading this down to like 6, 5, 4, whatever it is.
Yeah, well, the problem is that does not count people who are just unemployed, but also if you're looking at people that are looking for work but they can't find employment, or those that are stuck in poverty wage jobs, because that is functionally unemployed. If you're not even making enough to keep out of the poverty line, so really it's
we got
almost
some
a quarter.
Engineers that are washing cars. Yeah, they're employed, but they're not making the money of an engineer.
So unemployment rate, if you look at functional unemployment, it's actually a lot higher than that. And then we have this guy, Warren Buffett, very famous investor. He's got hundreds of billions of dollars in cash, and that's something he's had for years now. Yeah. Even with the huge gains we had the last couple of years, he missed most of that because he was expecting, and he still is expecting, a major crash.
See, he looks at the same stuff the Federal Reserve looks at, things that you and I don't really have access to a lot of that information. And so he knew almost 2 years ago that something is happening. The market is not sustainable the way it is. So he started pulling his cash out. And that was literally over a year before Trump got elected. So it had nothing to do with Trump or his policies or his tariffs. It had to do with what the market is actually based on.
And Warren Buffett is doing this so he can then buy another business when it's on sale later.
Right.
But in retirement, the reason you'd hold so much cash would be so that you can have a place to take income from when the market's crashing. Because if and when we have another market crash, and there'll be another one someday, whether it's next year or in 10 years, you're going to have another one. You need to have a place you can draw money from for income without selling while it's down. And that's the similar thing to what Warren Buffett's doing. Anybody know Warren Buffett's rule number one? Do you know Warren Buffett's rule number one? What is
rule
it?
Number one is do not lose money.
And what is his rule number two?
Very similar. It says don't ever forget rule number one. So it's basically don't lose money, don't lose money.
All right. So over the long term, the market's going to go up, though. We'll be fine.
It always does. Yeah. I mean, we got historical, it's always going to go up. But at what rate and when, that's questionable. So we'll talk about that.
And if you start to lose a little bit, is it too late to pull out?
No. I mean, if you're going to lose money, let's say you got a cut. I got a cut in my hand. So, Daniel, I'm coming to you as a doctor. I said, my arm's bleeding all over the place. Can you please stitch it back up? Well,
okay. We'll stitch you up. But first, I'm going to take the blood off the floor and try to put it back in your arm.
That's crazy, but see, that's what a regular advisor says. He said, "Oh no, it's just a paper loss. Don't move anything. Don't do anything. Don't make any changes because it's going to come back." No, the blood is not going to come back. You got to stop the bleeding first. Once the bleeding stopped, then we can talk about reallocation and infusion of new blood.
Okay. So then this is the actual S&P return from 2000 to 2022. It did go up over that time period. So take a guess. I'm going to pause for a second. Take a guess. What do you think was the average rate of return if you were riding it out with all those ups and downs and ups and downs? It did end higher.
Well,
what was the
that.
average rate of return?
I mean, it looks so high. It's got to be at least 12%.
What do you think? Well, it was actually 4.28%. That's all. 4.28%.
You know, I think I did better than 4.28%.
Well, you might have done better personally, and maybe if you're watching this, you also did better because you were investing money for the last 22, 25 years.
Yeah, you know, when your money's coming out of your paycheck, you're not actually writing a check, so it doesn't hurt as much. It automatically comes out before you even see it.
So if you count up all the money in your 401k, most of it is your own contributions and your employer match, and not necessarily growth on that money. Now, you could have gotten lucky and had a specific stock that went up huge, but the overall market only did that. Now, that's the reason is we lost 50% in the .com crash.
Well, if you lose 50%, you only need 50% to get back, right?
Well, you need 100% return just to break even, and it took 5 years. And then after that, we had lost 50%. Then we had to gain 100% just to break even. So for the first 13 years, there's 0% return.
But at least your advisor didn't charge your fees during that time, right?
Yeah, right. So you had to pay fees, you had to pay taxes during that time. And remember those three killers: risk, fees, and taxes. And this is why this is so important. Many people on this call, they're really concerned about taxes. And we want to help you with taxes. I want to reduce your taxes. But if you don't handle this risk piece, the taxes don't even matter.
Right.
It is
if you have
so
no money
much.
to pay, if you have no money to pay taxes on, what does it matter?
Exactly. So much more important to first tackle the risk, get rid of the risk in your portfolio, and then try to minimize the taxes. And we want to do both. They both work hand in hand, but you cannot do one really without the
You
other.
know, a thought just occurred. If I convert or save money on $1 million with taxes, and then it drops, and I just overpaid my taxes.
Exactly. You don't want to overpay on taxes. Now, what could you have done if you knew this market crash was coming? You
And
could have
is
bought
any other option.
You could have bought a 20-year Treasury in January of 2000 for 6.86%.
Oh, but you need to take risk in order to make a gain.
Well, look at this. If it was guaranteed by the government, you had $1 million in 2000. After 20 years, you'd have 2.4 million with all the ups and downs in the market. Or you could have 3.7 million by investing in 20-year treasuries.
So no heart attacks and more money. I'll take that one. So it doesn't mean that you got to sell everything and buy treasuries. What this means is there are not necessarily, you don't have to take risk in order to get money.
But you need to know the whole picture.
So we're going to show you this video. They showed where the treat is, and the dog's following that treat. Look, did he find it? Look at that. He's so smart. He knew exactly where that treat was. But they didn't show him where the rest of the treats were.
Now look carefully. He wants to spit it out.
And that's kind of what we feel like. If we don't have all the information, we want to get rid of the bad decisions you made. And that's what it comes down to. We want to uncover the other cup with all the information so you make better decisions. So that's the purpose of this video, is to show you that if you only have that one piece of information, yeah, you'll make that decision based on that one information, but it may be bad because you don't have all the other information.
All right, and so let's look at the different time periods, because some people say, well, you picked a perfect time, that 13-year period with zero gains. So let's look at other times. This is every 15-year period since 1996. You put on a year, take off a year, and so on. And only one time was it even above 8%. 4 times on the left side, it was under 3% return for 15 years. The
That's
average
crazy.
of all those periods was only 5.16.
And this is during the roaring 90s, and the market's gone so well, it's all-time highs, but it hasn't really done nearly as well as people think it has.
So let's look at back before. Surely it was better in the good old days. Remember the 13-year period of zero returns? Look a little to the left of that, we had a 26-year period of zero returns. To the left of that, we had a 52-year period of zero returns. So imagine putting $1 in. After 52 years, with inflation, you can only spend $1 worth of buying power.
That's crazy. But, it looks like, the market always does go up eventually, but do you have 100 years to do that? I don't know. So what happened? Well, originally, people invested in the market. I mean, why would people invest in the market? Here's why. Because originally people invested in the market because they bought a piece of a company, and the company made profits, and the profits came back to all the shareholders. And that was great. It worked well. And then we got rid of pensions. We got rid of those. And so we pushed everybody towards tax-deferred, IRAs, 401ks, and all those things. And you know what? Companies found out that people didn't really care if they paid dividends into a tax-deferred account because they weren't able to spend it. So if they weren't able to spend it, the company said, okay, we'll keep the money, and we'll make it look like we're very wealthy and rich, and our company's going to be in great standing. Yeah, but it doesn't work because it doesn't really help the economy so much. So there's a lot of problems there. And this is also, it is inflation adjusted, but it also does not look at dividends. So if we added dividends, there'd be a lot more growth in the beginning. And so dividends are very important. You can still find dividend-paying stocks that are great buys. So again, you got to talk to a professional. You got to take a look at the whole picture, not just the one treat. You got to uncover the other cup and look at all the information.
So we talk about bear markets. You hear that term on the news all the time. Bear market, bear market. What is a bear market?
So for the purposes of the next slide, a bear market is defined as a decline of at least 20%. But how many times does that happen?
It's really rare, right? The market mostly goes up. It's got to be pretty rare. Well, this is every single bear market since 1929, since the big stock market crash.
At 16 bear markets happens just about every 5 years, and it lasts about a year and a half. That's a long time. So this tariff, when we actually had kind of a bear market, but it was only a bear market for a week or so, and that wasn't really a bear market.
It didn't quite get to 20%. It was about 10, 12% down, I think, in 1 week. But it was starting that way. It was going that way. But a bear market really takes a while to hit the bottom usually. And 39% average loss. That's a huge amount. So even though we're taking every time it was over 20.
Right.
But a lot of times it was a lot bigger loss than that. And how long does it take you to recover from that?
It takes about a year and a half to hit the bottom of the bear market, and then it takes 5 years to recover. So that's 6.5 years of lost time. And if you're retired, you can't take money out because you're losing money. So if your market dropped and you're taking money out, you'll never recover. And that's the problem that most retirees are afraid of, is because if they start taking money out and the market crashes like this, what's going to happen?
So you tell me, you're my advisor, you tell me, I've got all my money in this one boat. It's dangerous. The bear market could hit
Diversify.
me. Diversify.
The big diversify word. It's
So
great.
I'm going to buy 4 more boats. So now I'm diversified, right?
That's awesome. Now your risk is diversified everywhere, right? Except they're all in the same pond. So if you have a tsunami, they're all going to be affected. So there's 2 different kinds of diversification. We're going to talk about first opinion-based assets and contract-based assets. That's one kind. So opinion-based assets are those assets that are based on somebody else's opinion. It's the market, gold, silver.
Gold and silver is an opinion asset.
Yeah, it's based on some crypto. It's all based on somebody else's.
But I know it's worth this amount.
But if you can't sell it for that amount, it doesn't make a difference. Now, it's done really well. It's grown well, but it could also go down.
So an opinion asset is anything that's somebody else's opinion determines what you could sell it for today.
Exactly. But then there's contract-based assets. Contract-based assets are like bank accounts, CDs, life insurance, annuities, rental contracts, mortgage contracts. Those are all based on a contract. You know exactly what's coming in, what you're paying, and those things are controllable. So that doesn't go down in a down market. So if the market goes down, your opinion-based assets may suffer, but then you have a contract-based assets where you can pull money out because you know that it's not going to change.
So if you have a whole bunch of different mutual funds, stocks, bonds, different things, that's not really diversified. You might be in different sectors, but it's still all based on somebody else's opinion. The true diversification would be to move some to contract-based asset so that you always have a certain amount you can draw from, just like Warren Buffett did. More than half his assets right now are in contract-based assets.
Yeah.
Okay. So again, insufficient data leads to bad decisions. We'll also talk about a different type of diversification later, which is tax diversification. So let's move on to fees, because the 3 killers are risk, fees, and taxes. Let's talk about fees. You're paying 1% to your advisor.
Yeah, so this slide shows really up to 5.5% fees. We're not going to go into all that, but that's New York Times and Forbes, and they could be there. But when we do an analysis, we find that most of our clients are usually at about 2 to 3% in fees. So let's talk about fees. So if I got $500,000, all right, I'm going to come to you, Daniel, as an investment advisor, and say, Daniel, I got $500,000. What can you do for me?
Well, if you have $500,000, remember the market only did 4.28% for the last 22 years or so. I'm going to beat the market, so I'll give you 5% return.
So what does that mean? How much money am I actually going to make?
$1.2 million of growth.
Wow, that's a lot of money. Over 25 years, I'm going to make $1.2 million.
Exactly. So for that, I'm going to charge a fee. I got to make a living, so I'll charge you 1% fee every year.
That doesn't seem too
And
bad.
I promise you, there's no other hidden fees, no other trading costs and cash out, all those other things we showed you, not happening to you. 1% all in.
That seems pretty fair to me. I'm going to make $1.2 million. That seems like a lot of money for 1%. I think that's worth it.
Let's count it up. Over the next 25 years, you end up paying $217,000 in fees.
Oh, man, that's a lot of money once you put a dollar amount on it.
Exactly.
And if I don't have that 217 in my account, then I'm not getting that 5% you promised me.
Exactly. So now that's a lost opportunity cost, which is another $159,000.
On that 217. So 217 plus 159 is $376,000 lost to fees and the opportunity on the fees.
That's crazy. And so if we take away the fees out of the 1.2 million you were going to get, take away the fees, you're left with 31% of your growth going to fees.
That's a pretty high tax, if you ask me.
It's not 1%, 31% going to fees.
If I'm concerned about 12 or 22% tax, but I'm paying 31% tax in fees, that's ridiculous. So
Exactly.
unless you're getting something valuable out of it, there's a lot of different opportunities. Now, 40 years ago, you didn't have that opportunity, but now you do. There's a lot of free platforms, a lot of ways you can save on those fees, and we can help you do that.
So click the link and make an appointment with us. Go to our website.
Unless, of course, you like paying all these fees. Yeah, then don't worry about it.
Exactly. So with the risk and the fees, it's really, really important to minimize those even before you get to taxes. Now, are all fees bad?
Not necessarily. It just depends on what are you getting for it. Because think about it. If you're paying, let's say you have $2 million in assets and you're only paying 1%, we're just on the low side, 1%. Well, what is 1% fee on $2 million?
$20,000
Every year.
every single year.
So in 10 years, you've paid $200,000. What are you actually getting for that $200,000? Are you actually getting an income plan? Are you actually solving your tax problem? Are you actually going to reduce that risk?
No, my advisor talked about taxes. He talked about taxes.
Did he? What did it say on his email?
Oh yeah, the email signature says, "This is not tax advice. This is not legal advice. Consult a proper tax attorney." That's who we are. That's how I am.
So do your emails say that?
No, my email signatures, my disclosures, they say this is going to be tax advice. This is legal advice pursuant to the retainer you signed with my law firm to give you that advice.
Yeah, I mean, we had a client that came to us. He just paid $9,000 for Roth conversion tax advice. And that whole report, it was many pages. It was a good report, but it said on every page, this is not tax advice.
Not only is this report not tax advice, this firm does not even provide tax advice. Well, then what are you charging $9,000 for to give that tax advice? It's really sad, but you need to have advice you can rely on. And it's important to take care of these risk and fees before we even get to taxes. So we are going to move on to talk about taxes in just a second. First, let's do the case study on how much of a difference it can make on risk and fees. So Bob and Carol, you're clients of ours, but they're fake names. They're not their real names. And they have about $1.6 million of assets they're not using, even though their pension and Social Security cover their basic expenses.
Right.
But why are they not spending out of this $1.6 million they have?
They saved $1.6 million for traveling. That's what they wanted to do when they retired. They wanted to travel, enjoy the world, enjoy experiences, but they're not doing it because they're afraid. And what are they afraid of? They're afraid of market being so high, money running out, taxes, fees, beneficiaries, daily volatility. Once you die, take it out. Low returns. All those things they're afraid of. And they've had a great advisor. They love this guy. He's done great. He's given them client appreciation events and everything for the last 22 years. However, they've never had a written plan on how to take the money out, how to minimize taxes, and make sure that money lasts and is also able to go to their kids.
So we put together our analysis, and we found out even though they were sure they were paying only 1% in fees, they were actually paying 3% in fees, which is $49,000 every single year.
That's a college education. That's crazy.
So to put that in perspective, every month you wait to make a change, you're spending $4,000 unnecessarily.
Wow.
Not only that, they're exposed to a $790,000 loss in the next bear market. So they'd have to gain 97% just to break even. And this is why they were afraid to spend. So we were able to reduce their fees significantly, save them $32,000 every single year.
So they went from $49,000 only to $17,000. That's it.
And then they are exposed to only a 9% loss in the worst market crash that could happen.
Yeah, and nobody wants to lose even $150,000. But if it's only 9%, what do they have to get back to even?
They have to only get 10% return the following year, and the market often does that after a crash. So this is a huge savings on risk and fees. We were able to help
once we were able to do that, we were able to put the income plan, then they felt much more comfortable retiring and having that income and being able to travel.
So now we have what you've been waiting for, taxes. We're going to talk about the new tax bills that were passed. We're going to avoid the political and stick to the actionable. So we're not really going to talk about whether the bill should have passed or whether there would have been a better one that could have been passed.
And there's a lot of things in the tax bill, but we're going to focus on things that really apply to retirees, retirement income, because that's what we focus on. But we can certainly help in the business laws
And
as
if
well.
you have any other questions about how it affects business taxes or how it affects taxes for people before retirement, go ahead and make the appointment with us. Click the link and schedule an appointment. We'll be happy to talk to you about all those other provisions. But first of all, the thing to
Uncover that
know,
cup.
you will pay taxes. Resistance is futile. Have you figured out that I like Star Trek by now? I really like Star Trek.
And he likes this slide for a couple of reasons. Not just because he likes Star Trek, but because it tells a very important truth. You will pay taxes. So the thing is, if you're going to play a game, any game you're going to play, what do you do first? You look at the rules. Find the rule book, figure out what the
Remember
rules
that kid that was complaining about Monopoly and the taxes? That was the rule. Taxes is the worst part of the game, but it's the rules. And if you understand the rules, you can learn how to play by those rules and use them to your advantage.
So if you don't want to read 10,000 pages of rules and taxes, then that's what you get a tax attorney for.
So we have a new tax law that passed, and if you like the bill, it's called the One Big Beautiful Bill. If you don't like the bill, it's called the ugly small bill. And if you don't like either of those terms, technically the real term is the reconciliation bill. That's what it was. That's why it only needed 51 votes in the Senate.
Yeah, but that's too big of a word.
So let's just call it the new tax bill.
Yes.
All right. So the new tax bill. What does the new tax bill do specifically for retirees? And we'll talk about those. There's like 900 pages. A lot of it doesn't really affect retirement. So some of the key points that really affect you in retirement years, or if you're approaching retirement, this is what it is. First of all, the current brackets remain the same. This is a really, really important point. The current brackets do not increase. The first Trump tax cut back in 2017 or 2016, it had a 10-year lower taxes.
And then expired.
So in 2026, it was going to have a massive tax increase on everybody. That is not happening anymore. In fact, it's permanently cut the taxes.
Yeah, many people would have saw a 20 to 30% increase in their taxes if it went into effect.
Now, what does permanent really mean, though? Is anything permanent in Washington?
Only till the next person gets elected.
Probably not. But at least for the next few years, it looks like they're going to remain the same. So that gives you a big reprieve if you're trying to do Roth conversions and other things. The other thing is standard deductions have increased to $31,500 now for married. So it was $30,000 at the beginning of the year. Now it's $31,500.
And it goes back all at the beginning of the year.
Exactly. So all of these positive changes go back to January 1st of 2025.
Just not till last year.
Yeah, not last year, but January 1st, 2025. So it really affects you and helps you for this year. Then we have the senior deduction. If you're over 65, you still get a married deduction of $3,200 added on top of your standard deduction.
But he promised something more.
Yes. So there's a bonus deduction. If you're over 65, $6,000 per person, whether or not you itemize. Now, this one, a lot of the new things we're going to show you here, they're only for 3 years, so they're not total, but not permanent. But this is a huge thing, $6,000 more per person, and it could be up to $150,000 of Maggie. What is Maggie? It's not MAGA. It's Maggie or married, unmarried. Now you got me saying this. We were joking before this session that it looks like married because we're talking about for married people, but no, it's modified adjusted gross income. Modified adjusted gross income. What does that mean? It's basically adjusted gross income plus non-taxable Social Security and a few other things.
And why do they make it so complicated?
Yeah.
Because they can.
But if you're under that threshold, then you get this deduction. Even if you're above it, you get somewhat of a deduction. So really, if you add all these together, it's a potential standard deduction of $46,700.
That could be huge for a lot of people.
So it really does lower your taxes, especially in that under $150,000 mark. Now, if you're thinking, well, I can't live on $150,000, I'm used to spending $20,000 a month. Well, we can make everything else Roth or other tax-free sources, and then you can get all that income without it affecting this taxes. So we'll talk about that in a few minutes. Then there's a cool thing that they added because a lot of people complain you're disincentivizing charitable contributions with the huge standard deductions. Nobody's taking it.
Most people went to standard deductions instead of itemizing because it didn't make any sense.
And so now you can do both. Up to $1,000 if you're contributing to charity, $1,000 per person. You can take that and still take the standard deduction. So that's really
standard deduction of $46,700 potentially, and still get another $1,000 on top of that for
each.
charitable.
So $2,000 if you're married. Yeah. All right. Then we have a state tax threshold. This was scheduled to drop in half at the end of the year, but that is now increased instead of dropping. It's increased to $15 million, and it also is indexed for inflation as well. So they say it's permanent. Again, for the next few years, it probably is, but we'll keep an eye on those changes.
For most of our lives, it's really been about $1 million.
Yeah, $1 million, $2 million, $500,000,
yeah.
Or and so state taxes are still something to think about. But
so anything above that, you pay a lot of money. So we'll talk about that later.
Now we have the big one that was talked about a lot: the SALT deduction. What does SALT stand for? State and local taxes. State and local taxes. So for the last 10 years, almost, you could only deduct $10,000. So if you either lived in a higher tax state or if you had multiple properties and the property taxes were above $10,000, you were limited to deducting $10,000 even if you're itemizing.
So this caused a lot of problems for more of the wealthy people that lived in blue states that had higher taxes. But now with $40,000, it opens that up. You can deduct $40,000, which makes it much more palatable.
And it's actually the same. Single is $40,000, married is also $40,000 total. But $40,000 is a big increase over what it was before. And this is in place until 2030. It actually increases a little bit more each year, and then in 2030 it's scheduled to drop back down to $10,000. So we'll see if they make any changes, but at least for the next 4 or 5 years, we're going to have this increased deduction. And then we also have a new deduction for loan interest on cars.
They have to be assembled in the USA, and they have to be purchased between 2025 and 2028.
So it's a complicated thing to qualify for, but if you are buying a car that was assembled in America, then you can deduct up to $10,000, and this is on top of your itemized. I believe it's an above-the-line deduction.
Of interest paid.
Of interest, yes. So
it's not an automatic 10,000 deduction. It's you got to look at your interest, and up to 10,000 of that is going to be deductible if it was assembled in the USA and purchased in 2025 to 2028.
And here's a new one: you can now deduct mortgage insurance. PMI.
This is not interest. This is the insurance.
Yes. So in 2017, when the tax laws had changed before, the $1 million limit on mortgages went down to $750,000, so that you can only deduct mortgage interest up to $750,000 of loan balance, and you could no longer deduct mortgage insurance (PMI). So if you put in less than 20% down into your house, then you have this PMI you got to pay for, and it's basically a tax almost because you really don't get anything for it. But now you can deduct that again. Your $750,000 limit still is the same, so you still can't deduct any home loans above $750,000, but you can deduct the PMI. This will incentivize people to put down less on their houses, which could help in the housing market.
So this will really help lower income people that don't want to tie up all their money. But also, as Daniel likes to say, if you don't need to have a mortgage, that's when you really should have a mortgage. Use other people's money. And this allows you to use other people's money at a lower cost.
All right. So what are the brackets? These are not expiring now. These are the actual brackets, and we're sticking with these. I want to draw your attention to the 24% bracket because that's where a lot of our clients land, is in the 24% bracket. And if you add the standard deduction, now it's only $34,000 because you're above now the $150,000, but $34,700 for being over 65. Really, $429,000 is the top end of that bracket. So if you're thinking about doing Roth conversions and you're at $206,000 of income, you have another, $220,000 plus that you can do in Roth conversions and stay in the 24% bracket.
So this is a great benefit of this new tax laws. It allows you to have more time to be able to convert that and pay less in taxes.
All right, and we'll talk more about Roth conversions in a few minutes. Now, we have the long-term capital gains brackets. These are not changing under the new laws, so they're staying the same. And
most people think they got to pay 15%, but you know what? What if you could pay zero on your capital gains? And this is how you do it. If you remain under $96,700, that means you can really have $143,000 income. If some of that income is capital gains, you don't pay taxes on the capital gains. I'll give you an example. Let's say you have $60,000 Social Security, both you and your spouse, and then you sell Microsoft stock
for like $80,000.
$80,000. Do you pay capital gains?
No, you pay no capital gains because your total income is less than $143,000, which includes that standard deduction for being over 65.
So this allows you to harvest some of the capital gains and not pay any taxes on it. So it's very important to know how you pay taxes and how it affects you. So that's why we're trying to uncover that other cup that the dog didn't get to see. We want you to have all that information so you make better decisions.
We have clients that are spending $20,000 or $25,000 every month in retirement lifestyle, and they're paying zero federal income tax because they've taken the proper steps ahead of time to minimize those sources, and now they're able to take advantage of that because the Roth doesn't count towards this threshold. All right. Now, the real tax system is more complicated than just the brackets because we have required distributions to deal with. We have, again, capital gains, Social Security. I want to talk about Medicare premiums for a minute because Medicare premiums, you pay more for Medicare when you have higher income. And a lot of people are concerned if I do these Roth conversions, I'm going to pay too much for Medicare. You've heard of Uncle Sam, where we have Aunt Irma for Medicare, and Irma, IMRAA, which is basically they look at the income you had 2 years ago and they increase it for the cost of Medicare.
You may have paid a lot more in Medicare taxes when you were working because you made a lot of money, so your taxes was higher for then. And it's higher now because you make more money. It's like they tax you twice on the same stuff. It's crazy.
But don't miss the forest for the trees. Remember, we save most of our clients over $1 million in taxes. If one of the consequences of that is for a couple of years you pay $200 a month more for Medicare, that's a good trade-off. Again, as a tax attorney, rather than just an accountant or CPA, which is more short-term generally, tax attorney, I think of a long term, and I really don't care whether you pay more today in taxes. I care whether you pay as little as possible over your lifetime. And that's what we're going to talk about. Now, how do RMDs work? First of all, RMD, required minimum distribution. What is an RMD?
RMDs are a four-letter word to most of our clients because they don't need it, right? They've saved this money, but they have other income. They got pension, they got Social Security, they might have dividends and interest, and now they got this big, huge pile of $2, $3, $4, $5, $7 million in IRAs. And they're like, well, I don't want to take it out. Well, the government says, hey, you've had enough fun. You defer to the taxes, now you got to take it out and pay taxes. So what do? You take that whole balance and divide it over your life expectancy. And if you don't know how long you live, well, the IRS put a number on it. Don't worry, it's a generous number. They tell you all the way to 99. Why? Because they want you to pay taxes for the rest of your life. And then they want your kids to pay taxes for another 10 years. This is not to help you pay less taxes. This is to help you pay as much taxes as possible. So,
And every year is a smaller number you divide it by. So what does that mean?
that means if you divide by a smaller number, then a bigger number comes out. But you pay more taxes. You'll never be out of that IRMA then. So if you don't take advantage of some of the rules now, you'll be paying higher IRMA for the rest of your life and have a cascading effect on all your taxes.
I talked to a client just the other day, and I was saying, you need to do some Roth conversions. He said, well, but I'm going to pay too much for Medicare and this and that. I really don't want to pay all those taxes now. I'm sure I'll be in a lower bracket later. And we calculated in just a few years, his required distribution would be more than today's total income he's getting, even while he's working. And it's going to be a mess. So he really, and then he decided, yeah, I guess I should do some conversions now.
You're going to be in a lower tax bracket is really mostly a lie for most people.
All right. So what about capital gains? So if you got a 1099 from your brokerage account, not your IRA, but your brokerage account, you received a 1099 even though you didn't take any money out. So that's a phantom gain. So how does that happen?
So that happens when a mutual fund manager will sell a highly appreciated stock to buy a lower stock, which is good. It's good for you. But he doesn't pay the taxes. He sends it off to you. He sends the 1099 to you. So that happens. And then if you have a brokerage account, set it up for automatic rebalancing, which is great. It protects you, right? But that's also going to send you a 1099. So those 1099s, those long-term capital gains can actually push your income tax break higher. So you might end up paying higher income tax just because the capital gains, which you didn't even spend, happens.
And then we have this 3.8 net investment income tax. This one did not change in the new tax bill. You have a tax on high income. It's a tax on the rich. Now you can decide if you, on this call, if you think that $250,000 of combined income for a married couple is rich, but that's what is considered the tax on the rich. And it is also assessed instead on capital gains as well if you have a bunch of that.
And this could be easily put into another reconciliation bill in the future. We're not changing the taxes and only the tax the rich, and this could happen. But right now it's only 3.8, which is good.
Now we have Social Security. Social Security, you have a choice between 62 and 70 to take Social Security. And think about what do most people say as far as taking Social Security? Is the conventional wisdom
wait as long as possible.
As long as possible.
You're going to grow by 8% every year.
You know, why? Well, we have an 8% higher chance of dying every year. That's the reason.
So
we tell our clients, many of our clients, actually take Social Security as soon as possible.
And that means that you got to wait till full retirement age first. Because if you're still working, you can't really take Social Security, because if you're still working and making more than $23,400, which has gone up a little bit, then for every $2 you make, $1 Social Security goes away, never to come back. So unless you're getting a 1099 and you own your own business, there's loopholes and ways around it. Otherwise, you really can't take Social Security. You got to wait till 60, full retirement.
But you don't need to wait till 70. You can actually take it at full retirement age. And if you want to retire early, like I said, most of our clients are able to retire 3 to 5 years sooner than they thought was possible after working with us. Right. So you could retire at 62 and take Social Security. And why would that be a good idea? Well, first of all, we're going to talk about taxes in a second. You might have heard on the news that there was a promise made there will be no tax on Social Security in the new bill. That's not specifically in the new tax law. However, remember we talked about this $6,000 bonus deduction for being over 65. That's supposed to do that. The reason they couldn't just change the Social Security tax is because they would need 60 votes in the Senate to do that. They can do this one with only 51 votes. So they just added a deduction whether or not you're taking Social Security. If you're over 65, you get that $6,000 bonus deduction.
So you don't get that at 62, you get it at 65.
But that does help to reduce the impact of taxes on Social Security. So let's talk about how Social Security is taxed, because this part did not change.
Well, provisional income. If you don't think this is English, it is English, but it's the federal government doing this. Take 50% of Social Security, then ordinary income, dividends, capital gains, and all your non-taxable income, and they come up with a term provisional income. And that determines how much of your Social Security is going to be taxable.
And look at the bottom line there. $44,000 is the threshold for married. That means 85% of your Social Security will be taxed.
So at least 15% will be tax-free.
Exactly. 15% of it is always tax-free. Now, how does that work? Let's look at this.
So it's pretty complicated, but let's give you an example. If I'm going to retire, my wife's going to retire, I'm going to take the conventional advice. I'll take Social Security. I need $60,000 to live, so I'll take $40,000 out of my IRA and $20,000 Social Security, and that'll be $60,000. So I'll have a total taxable benefit of Social Security of about $11,000, which doesn't seem too bad.
And let's say I retire at the same time, and my wife and I both take Social Security, so we don't have to take as much out of our IRA, And that means our IRA lasts longer, but also our provisional income is less, so the total taxable benefit's only $4,000 for me. Now we look at the tax return. Raz would have paid $2,500 in taxes, but I would pay $0 in taxes, and I still have a lot more room in my standard deduction, so I could be $5,000, $10,000 richer every single year.
And this slide doesn't show the new standard deduction, which is much higher. So you could actually end up having a lot more money, especially if you took Social Security early and let your other money grow.
Exactly. And so what is another reason? Now, you could take Social Security early and you get $2,500 a month, maybe, if you max out your earnings.
Yeah, but if you wait, you're going to get almost $2,000 more per month. That's a good reason to wait.
Well, let's look at it. Let's look at the math. What do you miss if you wait? You miss the $2,500 you could have gotten for 96 months. That's $246,000 loss.
That's $250,000. No, you should take it early.
Well, you are going to make it back eventually, right? If you live long enough, you're going to make more per month, so you're going to break even in 10 years. That's age 80. So
Okay.
now, but wait, there's more. If you didn't need the money,
Then you didn't have to take it out, right?
if you didn't need the money, you could take Social Security and let your investments keep growing, or you could just invest the Social Security if you really don't need it.
So a
And
combination of that, let's say you get 6%.
all right, that's a $315,000 loss now, and now your break even is age 83.
So I got a question for you, Daniel. If somebody turns 62 today, what is their life expectancy?
Exactly 83.
So the Social Security is not trying to pick favorites. They don't care whether you take it early or not. They want to pay you the same amount no matter what happens. But the problem is, Social Security dies with you. Okay, your IRA does not. Your IRA can go to your kids. Social Security does not. In fact, they give you a whopping $255 if you die.
$255.
They haven't changed that for 70 years. It's crazy. So use Social Security and let your other money grow as much as possible. Because I'm going to tell you something really important right now. Listen carefully. You will never, ever, ever be younger or healthier than you are today. So take the money. Enjoy it.
All right, and now there's one more piece, which is the inflation. In 2025, people on Social Security got 2.5% increase for inflation. Please
That's just not fair.
think about, do you believe this inflation was really only 2.5% last year? So this should tell you that it is worth more to you to take Social Security now than later. So why is it that most people say, most advisors, most of the media says, wait for Social Security?
They're talking to the general public, right? The general public doesn't make as much money as...
So that's important. This webinar is not tailored specifically for just the average person in America, because the average person in America doesn't pay any taxes at all. Okay, the average person in America makes less than $35,000 total at the height of their career. The average person in America retires with less than $10,000 saved altogether. So if you're watching this webinar, you're trying to learn about how to save money on taxes. That means you're paying taxes. So you're not the average American.
Well, the thing is, just to be clear, they're still paying taxes, but hidden taxes like gas taxes and sales taxes.
And
all
payroll
those things.
taxes and all
Right,
that. So yeah, I'm talking about federal income tax, what you can actually reduce if you're paying
doesn't
it.
apply to them.
Right, but if you are paying those taxes and you can reduce them, there are things you can take advantage of that not everybody has the opportunity for. So that's why I say for most of you watching this call, it probably makes sense to take Social Security early. Now, the real tax system and the case study, let's look at this. John and Jane, they're married, they're 73, they got $60,000 in Social Security, $15,000 of capital gains, and happy birthday, pay more tax because you turned 73, now you have all these required distributions.
And they didn't want it, but they got to take it.
We put this through our tax calculator. Even though the red line, the 12% bracket, that's where they are, they're paying 49.95%, almost 50%.
Get out of here. That's crazy.
That's crazy.
Show me how that works.
Well, remember the $1,000 required distribution should cause $120 in taxes. That's 12%.
Right. It did do that.
But that causes $850 of Social Security to now become taxable, also at 12% for $102. That causes $1,850 of capital gains to now become taxable at 15% for $277. So the total tax burden on just the $1,000 withdrawal, $499.50.
And that's what I was talking about earlier when I said cascading tax effect. Your capital gains could actually cause income tax growth, right? And that is a problem.
So what tools can you use if you are not the average American? Diversify, right?
Yeah.
Not just IRA, but Roth, non-qualified, other tax-free real estate.
So this is the other kind of diversification we talked about. So we talked about opinion-based assets versus contract-based assets, but now we're talking about tax diversification. So these accounts are taxed differently. And that's very important because if they're taxed differently, and you only use tax-deferred products where appropriate, then you can properly blend withdrawals from different accounts. So as a tax attorney, they love this because they can say, well, because the tax laws have changed, pull money out of here instead of here. And because the tax laws have changed, pull money out of here instead of here. Having this diversification gives you much more control of where to take the money out of.
And then when you're thinking about what investment you're going to purchase, you should also think about what is the best tax status for that investment.
Ooh,
a lot of times people get backwards what this is.
I got it. So hear this out. So I heard on the radio that I was driving. I heard this on the radio. You might have heard this too. It said, you know, you can take your 401k and you can convert it to a self-directed IRA and buy real estate. It's the best thing sliced bread.
That's a terrible idea. Don't do that. Why should you not do that? Well, if you hold your 401k inside or an IRA, you hold real estate inside of it, then you have high maintenance and management costs. What happens if you need a new roof? You can't contribute $20,000 for a new roof into the IRA. You're limited to $7,000 or $8,000. So what can you do? You have to borrow. But most banks don't lend to an IRA, so you have to borrow at a very high interest rate. And the worst part is all those great tax benefits from owning real estate, the tax-free income because of depreciation, then you die and give it to your kids they pay no capital gains tax, they can start all over again. All of that's gone if it's inside of an IRA. So we do like that some of our clients have real estate even in retirement, but you do need to have it outside of your IRA.
So you're saying real estate is good, but you want all the benefits of real estate, and inside an IRA, you don't get the benefits.
Exactly.
All right. So I heard this other thing. This is also all over the place. As you approach retirement age, you hear all these things. The targeted towards you said, as you're retiring, you want to be safe. The risk. We agree. You shouldn't take a lot of risk. So I saw this guy. He's saying, well, you should buy an annuity because a fixed index annuity, you can't lose money. So I thought that was a good idea. I mean, I could lose money in the stock market. So I went and sold my Microsoft stock, which is in the stock market. Yeah, I had to pay a bunch of capital gains, but now I'm going to be safe. So I moved that to the annuity.
That's not a good idea.
Really?
No, because you just told me you paid a capital gain on your brokerage account when you didn't need to. A huge capital gain, and then you purchase an annuity which will give you income tax later, which is worse than capital gains.
So what else could I do? If I wanted an annuity, what else could I have done?
Well, assuming you had a choice, you had some IRA money or 401k money, you could have used that for the annuity.
But if I moved my IRA to the annuity, wouldn't I have to pay taxes?
No, there's no tax on that transfer. It's still an IRA.
So I can move my entire TSP or 401k to an annuity and pay no taxes.
Exactly. Not currently. And then when you take the money out, you do pay income tax, but you were already going to pay income tax on that money.
So nothing changed.
Nothing changed.
Except that I'm safe.
Except you're safe, and depending on hopefully you get one that actually does have that as advertised, because there's a lot of hidden features.
So we're not saying that annuities are bad. They could be good, but as a fiduciary, we don't know if they're good for you. What we're saying is find the right asset to put in the right kind so you don't double pay taxes.
Exactly. And so I heard somebody say, there's nothing better in the world than guaranteed lifetime income, which some annuities provide. There actually is something better. It would be tax-free guaranteed lifetime income. Oh. So, you can convert this to Roth or other tax-free assets, and then it'd be even better. Now, we talk about RMDs. We're going to talk about Roth conversions and then also CRUTs. And so let's first talk about what is a Roth. A Roth is the opposite of an IRA. You pay tax on the seed and not the harvest.
But the problem is most of you guys worked and made a lot of money and couldn't do a Roth, right? So you didn't have the Roth opportunity. So what could you do now?
Well, you can convert to Roth.
With no income cap.
No income cap. So if you have $100,000 or $1 million in an IRA, you want to put that into a Roth. It doesn't matter what other income you have. You do have to pay tax on it. But there also is a 5-year rule to be aware of.
Yeah, but isn't there a strategy of how much you should convert and trying to stay within the tax bracket?
Yeah, that's what we help you with. So we talk to our clients about how to minimize the taxes by converting just the right amount each year. So click the link and make an appointment with us. We'll be happy to talk to you about that.
And the 5-year rule only applies if you're under 59, then you got to wait 5 years to use the money. And if you're over 59, you only have to wait 5 years for the growth. So for example, let's say I converted $100,000. I don't need it, so I let it stay there. And now it's $120,000 2 years later, and you know what? I need the money because one of my kids is getting married. So I can go and get that $100,000 out. I just can't touch the $20,000 that it grew to for 3 more years because that's how much the 5-year rule is.
And there's no required distributions. So you don't have to take money out if you don't want to. It's
not
better,
even for your kids.
No. And the kids might have to take, so the kids do have to take it out within 10 years, but they don't pay any taxes. It's better to pay a little bit more now than to pay a lot more later. And how much more would it really be later? Well, thank you for asking. I have a slide about that. So this is a client of ours.
So I'm going to come to this client. So I've got $1 million. Mm-hmm. Okay, I don't really need it. I'm 62 years old. I'm going to let it ride. Just let the RMDs. I'll just pay those when that happens because I don't really need it.
And you're going to leave this to your kid.
Yeah.
All right. So let's say you're going to leave this and you have $523,000 to pay in required distribution taxes.
But I only have $1 million.
Oh, it grows and you pay tax. It grows, you pay tax.
So this is based on a 5% growth?
Yeah, only 5%. And it's assuming taxes never change for the rest of your life. That's probably a bad assumption. But if they don't, Then you also pay $200,000 in reinvestment tax. 'Cause
Why?
You didn't need the money.
Oh, you're right. I
gonna,
don't need it.
You're going to reinvest it. Then when you die, your beneficiary is going to pay $434,000 in taxes.
But I only had $1 million. I'm paying $1.1 million in taxes.
Yeah, it's crazy. But if you convert to tax-free, then you pay $300,000 potentially, but that's it. No more tax on the growth, no more tax at death, and that's a huge savings, $850,000 savings. Now it does, it could be even less if you convert it over several years, and we'll help you minimize that as much as possible.
And that's why you need a tax attorney to try to find out all the loopholes, all the ways you can do it. And this is one of the loopholes. This has been around for 56 years. A CRUT, Charitable Remainder Unit Trust. So, again, you can move money into charitable. What can you move in? You can't put an IRA in there.
No, not an IRA. It's for stocks or rental properties or a business you're selling.
And do you have to put all of it in, or could you put part of it in?
You can just put part of it in. Okay. And there's no capital gains when you put it into this charitable trust. So the trust sells the property with no capital gains at all.
And then what else you get?
Then you get a giant tax deduction. It could be 50% or more of what you're putting into the trust.
The older you are, the bigger the tax deduction, right?
And then you get a taxable pension out of this, 5% basically of whatever you put in, 5% for the rest of your life.
So I put all this money in this house in there, and I get an income, a pension for the rest of my life.
Exactly. Now, when you die, whatever's left has to go to charity. It says 10% minimum, but it's the entire account goes to charity. It's just if you drain it too fast, then you have to freeze it so that 10% goes to charity. All of it goes to charity when you die, but you get all these upfront benefits. So what can that help you with? And
well, what if I don't like charity? I mean, I heard these charities have like 90% overhead. So could I do something else?
yeah, you could start your own charity. It is legal to do that. You just have to make sure it's set up properly and it complies with all the IRS guidelines.
Like the Trump Foundation, the Clinton Foundation, the Bill Gates Foundation.
Yes, or you can do one that you feel is actually doing better charitable causes than those, and that's allowed, but it does need to be set up properly. Now, let's use an example of a...
Pause for a second. Do you set up foundations and trusts and things like that?
We do. We set up trusts,
So you
we
can
set
do
up
it for-
foundations. Our firm does that, yes.
Okay.
So you can click the link and make an appointment. We'll be happy to
Very
talk to
important
you
we do all
about
of this
setting
stuff.
those things up. All right? Now, charitable remainder unit trust, here's a calculator.
I've got $500,000 in Microsoft stock.
And I told you not to sell it to put in the annuity, remember?
So what could I do?
So what you could do, if you wanted to get rid of it, you say you're too heavy in Microsoft. So you take the $500,000 and you put it in this charitable trust.
Okay.
And let's say you're 65 years old, you get a $222,000 charitable deduction
So I could take that 222 and take it over to my IRA and convert that 222,000 of IRA to Roth.
with no tax at all.
No taxes. Wonderful.
You also save
Sweet.
$100,000 in taxes and capital gains,
Sweet.
and you're going to get this pension, $25,000 a year for the rest of your life.
But I don't really need that 25,000.
You already have a pension,
I already have one.
so you don't need more pension. So now this $500,000, let's say you don't want to do the complicated, set up your own foundation. You're going to give the $500,000 to your church.
Okay,
All right.
okay.
So the $500,000 goes to your church when you die, and that's great. But you kind of are a little bit upset that your kids now no longer get this $500,000.
yeah,
We're going to inherit that.
That's not so good.
So since you don't need the income, let's take the $25,000 a year and let's buy life insurance with it.
But I heard life insurance at my age is too expensive.
Well, it could be more expensive than it was when you were younger, but it's still always worth it because your leverage is so much more for life insurance if you can qualify.
So is life insurance still the most efficient way to transfer wealth to
Yeah, for $25,000 a year, you might get $1 million,
What's the
maybe
catch?
$2 million of death benefit.
What's the catch?
There's no catch.
I gotta at least be healthy.
You'd have to be. Yeah, that's true. You'd have to be healthy, and it does take some time to qualify and all that. But if you can do that, you take the $25,000 a year and buy life insurance.
So over my life expectancy, if I'm 65 now, that $222,000 turns into $850,000 of tax-free Roth. That $1 million life insurance policy turns into $3 million of tax-free death benefit to my kids. So I now converted that $500,000 to $3.8 million of tax-free money to them, and the church gets $500,000 when I die.
Exactly.
What a deal.
Everybody wins except for the IRS.
Yes.
So it's okay. All right. And then how high tax has been historically? The highest tax bracket currently is 37%, but in history it was actually 94%. That's huge.
That's crazy.
And look at the rate on only $10,000 of income. Back then it was 40%, above 40%, 42%.
It's the blue line, the top number on the right-hand side.
So that is a huge deal. If you are in a lower bracket in the future, the bracket itself might be higher. So keep in mind, nothing is permanent in Washington. Even though we have a great tax bill that just passed for retirees right now, that could change very soon in the future. We'll see what happens. Again, insufficient data causes undue stress. I don't want you to be stressed. I want you to have all the tools to be stress-free in retirement, and that means to reduce those three stress causers: risk, fees, and taxes. Okay?
Right.
Now we'll talk about estate taxes. You have a $15 million exclusion. We just talked about that earlier. It's increased, and there's a 40% tax on the excess, though. So you really do need to make some plans if you're getting close to that.
Now,
talk to
one
us.
caveat, I mean, you may live in a state that has a lower estate tax. So, for example, Maryland, it's only $5 million. After that, they charge 16% in estate tax, even though the other is 15%, $15 million.
Right, and so your state, by state case, it varies. We can talk to you about your state when you call us and make an appointment. You could give more than $19,000 away. That's just the amount you can give away without reporting it. So gift tax is the same rules, $15 million.
So if I give $1 million away, do I have to pay taxes?
No, not until you give more than $15 million away. So you're just fine. Now, what's the thing? Should you have a trust and not just a will? Yes, because it bypasses probate. It goes outside. It doesn't save you tax just to have a trust, but it saves a lot of time and money. Probate taxes.
Probate fees, you got lawyer fees, all those can be very expensive. Some states are more than others.
And then there's all these irrevocable trusts that may apply to you, especially CRUTs we talked about before. Beneficiary designations trump everything. So if you have a great estate plan, but your old 401k, the beneficiary still has an ex-spouse that you gave half the money to, they get the other half when you die. So you want to make sure that the beneficiaries match your current estate plan.
And we do all of these trusts, right?
Yes, we do those trusts. Now, what are great things to leave to kids? Real estate, mutual funds, stocks, bonds. There's no capital gains at death. Stepped up basis. That's great.
A step up in basis basically means that they get a value of what it is at currently, and they get to deduct it all over again if it's deductible. They pay no taxes at that point, right?
Yep. And so then what is the worst thing to leave to your kids in the current tax environment?
IRAs, 401ks.
Yes, because they have to pay all the tax within 10 years. They're not allowed to stretch it out anymore. Best thing is Roth IRAs or life insurance. These are the most tax-free, most efficient things to leave to your children. Now,
so if you leave your house to your children, I mean, my kids are fine. They love each other. They're happy. They're friendly.
Yeah, but then I want to sell it. I want to rent it. I want to move in. And now these are your 3 happy, loving kids.
So they were happy until I caused that problem.
Right. And even if you have a trust, the trust should say the house must be sold or the house may not be sold, but you should decide so your kids don't fight about it. All right.
So other apparent pitfalls. You got the other tax, the market risk. It's very important. It is a tax, and you got to protect yourself against, especially when you're retiring, because we know that you're going to have down markets in the future. We just don't know how many or how often, but it'll be there. And it happens about every 5 years. So protect yourself. Then long-term care costs. You don't have to have long-term care insurance. You just have to have a way to pay for it. And there's lots of ways. And so we can talk about that. Inflation. Now, I've heard inflation's pretty high, right?
How high?
Well, inflation is so high that the big oil had to lay off 30 congressmen and 10 senators. All right. Anyways, then there's boomerang children. Yeah, boomerang children, you've heard of those? Well, these children that you've paid for their boyfriend, their girlfriend, their clothes, their car, the car insurance, you pay for their college, and you launch them. And what happens? They come back. Well, we have a solution for that.
Kids won't move back home if they can't find it.
That's right. Keep it moving, guys.
So contact us if you also want to buy an RV. All right. So what happens when you make an appointment with us? We've talked to you about, click the link and make the appointment. The first call, it's a video call. We don't do any in-person meetings.
Absolutely free. No cost to you. We find out more about you. We are fiduciary in this call.
How long does the call take?
15 minutes. And you don't have to wait in line. You just, when you schedule, it's there. We pop up and we can answer your questions. We can find out more about you and see if we're compatible. If there's something we can do to help you. And if we do that, then we do what's called a free, or it's called a pre-approval, right?
Yep. So a pre-approval with us, without us. Remember that, with us, without us. Risk, fees, and taxes, how to reduce those. So we give you a tax plan, a risk analysis, a fee analysis. We give you an income plan, show you how much you can sustain every month without running out in retirement.
Yeah, but that's like $6,000. I'm only paying $20,000 to my advisor.
Yeah, it's $6,000, but it's only $500 for those of you watching this webinar. You do need to click the link and make the appointment to the free call so that you can be eligible and we can find out to give you that pre-qualification offer. And we're going to identify, at that point, you have 3 choices. Choice number 1 is, thank you for this plan. This is great, but, I want to do it myself. That's fine. You can do it yourself. We'll give you all the tools. We don't hold anything back.
Well, I mean, we're going to give you what we can do. So we're going to identify the problems. We're going to show you how much we can save you. But we're not going to give you all the ingredients in there because that's what we do. And it takes time and effort, and that's what we have attorneys on staff. So we're going to give you what you can save and why it's important to do these things, but then you can do it yourself. If you want to know exactly how to do it, then you work with us. Or you can take it to your guys and say, can you put this together? And they got to come up with the ingredients.
And you do also have a choice. We do have a money-back guarantee. If you don't like any of the ideas, you can get your money back. That's just fine. But a lot of times when clients work with us, they are only doing some of the things with us. They still have other advisors. So the changes we're making, some of them are very small. So talk to us, make the appointment. We'll go through this plan. We'll give you the risk, fee, and tax analysis. We'll give you an income plan. And we'll really look forward to talking to you.
So this pre-qualification offer is we're uncovering the other couple with all that information, and then you can decide what you want to do with that. When you get that information, you can either work with us or work with somebody else. It's okay, but you need that information to make better decisions.
So thank you for joining us, and we'll look forward to talking to you soon. Go ahead and click the link and make the appointment with us at Higher Ground Financial Group.